HMRC already knows exactly how much interest you've earned on your savings accounts this year because banks now report it directly and their AI system cross-checks it against your income and lifestyle data. The scary part, most people have no idea this is happening or that they could already be facing a tax bill. And it's not just millionaires, ordinary people, pensioners with cash reserves, couples with joint accounts, even people with an emergency fund could all find themselves owing tax they didn't realize they had to pay. HMRC expects to collect more than £6 billion in tax from savers, and at the same time, the government is reviewing salary sacrifice schemes, another potential clampdown. How does this affect you? And more importantly, what can you do to stay compliant and protect your money? Let's break it down. Banks and building societies now report the interest you earn directly to HMRC every year. If your savings generate more interest than your personal savings allowance, HMRC doesn't wait for you to file a return. It can automatically adjust your tax code or send out a bill. And from April 2027, banks will also collect your national insurance number with every savings application, and for existing customers too. That makes it much easier for HMRC to match accounts to taxpayers and close loopholes. Which brings us to the allowances. Basic rate taxpayers get up to £1,000 of interest tax-free. Higher rate taxpayers get only £500, and additional rate taxpayers get zero allowance, plus the savings starter rate, which gives low earners up to £5,000 more if their income is under £17,570. Anything above these limits is taxable, and unless it's inside an ISA, HMRC is told about it automatically. With savings rates at 4 to 5%, it doesn't take much to cross the line. If you have £20,000 in cash, at 5%, that gives you £1,000 interest, already maxing out the personal savings allowance. And here's where HMRC goes further. Their AI system called Connect doesn't just look at your bank. It pulls in data from credit cards, the land registry, DVLA, even airline tickets and social media. It builds a profile of your income, your spending, when you return to the UK if you say you're non-resident, and even whether you might have undeclared side hustles or rental income. The goal is to spot people who should be filing a self-assessment return but aren't, and to catch mismatches between what you report and the tax you should be paying. HMRC already knows far more than most people realize. If you're finding this useful so far, hit the like button so more people get to see it, and it lets me know you enjoy content like this. And don't forget to hit subscribe for more UK investing and personal finance videos, and drop a comment with topics you'd like me to cover next. Who's most at risk? 1. High savers. Maybe you sold a house or just built up a big cash pile. At today's rates, the interest quickly adds up. 2. Joint account holders. HMRC automatically splits the interest 50-50 between account holders, no matter who actually put the money in, unless you've officially declared a different split. And that can easily push one partner over their personal savings allowance limit without them even realizing. 3. Elderly savers with large balances in fixed-term deposits or savings accounts. And remember, if your savings or investment income tops £10,000 in a year, you would need to file a self-assessment tax return. And it's not just savings. The government is also reviewing salary sacrifice schemes. These let you give up part of your salary for things like pension contributions, cycle to work, or electric cars. The big perk is lower income tax and national insurance, but HMRC calls this a loophole, and it's expensive for the Treasury. Recent government papers set out 3 possible reforms. The first option is to scrap the NI exemption, so both employees and employers pay more. The second option is to remove both income tax and NI relief, wiping out the benefit altogether. And the third option is to cap the relief, for example, at £2,000 a year. Employers fear option 2 the most, but any of these changes would mean less tax efficiency for workers. Here's how this plays out in reality. 2 spouses share a joint savings account. Together, they earn £2,000 interest in a year. HMRC counts £1,000 for each person. If they're both basic rate taxpayers, no issue. But if one is a higher rate taxpayer, only £500 is tax-free for them. The rest is taxed, and HMRC can quietly adjust their code. An elderly mother and daughter hold a joint account. HMRC still splits the interest, and if the mother passes away, HMRC can investigate how the money was shared for inheritance tax purposes. Or take John, a pensioner. with £70,000 in savings. At 5% interest, that's £3,500 a year. His personal savings allowance only covers £1,000, so £2,500 is taxable. At 20%, that's £500 tax bill. So here are practical steps to stay ahead. 1. Max out your ISA allowance. Each adult gets £20,000 a year tax-free. Couples can shelter £40,000 together. 2. Consider premium bonds. Winnings aren't guaranteed but are tax-free. 3. Use pension contributions to reduce taxable income. 4. Track your interest. Always download year-end statements, especially for joint accounts. 5. Elect beneficial ownership. If you and your spouse share assets, you can file Form 17 to change the default 50-50 split. 6. Keep records. Tax codes, HMRC letters, account statements, they will save you headaches later. Remember, HMRC doesn't just send reminders. Missed reporting can trigger penalties from 15% up to 100% of the unpaid tax, depending on whether they see it as careless, deliberate, or concealed. The UK tax net is tightening. Frozen thresholds, shrinking allowances, AI monitoring. HMRC has more tools than ever to make sure no one slips through the cracks. The message is clear. The days of quietly collecting savings interest without HMRC noticing are over. The best defense is smart planning and using every legal allowance you can. But what if you're planning to leave the UK altogether? What happens to your ISA, your pensions, and your investments once you're no longer living here? Click this link to find out. Thanks for watching, and I'll see you in the next one.